Looking back at 2011, looking ahead to 2012, the latest webinar in the Wilkin & Gutton Plan series of webinars for community associations. My name is Jules Frankel, and I'm a shareholder with Wilkin & Gutton Plan. I spend a significant amount of my time working with condominium associations and co-ops, and I'll be the moderator for this afternoon's webinar. Let's go through a few housekeeping items before we get started. First of all, use the questions pane in the GoToWebinar dashboard to submit any questions or comments you have as we proceed through the presentation. We'll either address the questions as we go or answer them at the end. Next, we will keep the presentation to a maximum of 1 hour. At the end, there will be a slide with the presenter's contact information. A recording of the webinar, as well as a copy of the slides, will be placed on our website, www.wgcpas.com. You can also find recordings of past webinars there, along with other resources for community associations. Please keep your eyes out for additional webinars we have coming up. Throughout the presentation, we'll have a few polling questions. They'll pop up on your screen, and we'll speak about the results as you reply. Finally, we welcome your feedback as to suggestions for future programs or comments on this program. Moving on, today's program will be focusing on the benefits and insights that both board members and property managers can gain from both looking back at 2011 as well as specific action steps you can take during 2012. We have 4 presenters: Joe Chorba from Wilkin & Gutton Plan, Debbie Pasquarello from DHB Insurance, Mohammed Saliani from Wilkin & Gutton Plan, and Rich Hausler from UBS Financial Services. Joe Chorba is a supervisor at Wilkin & Gutton Plan. He divides his time between working with clients in the real estate industry and closely held businesses. As part of his real estate expertise, Joe works with a large number of condos, co-ops, and homeowner associations in both New Jersey and New York. His work with them includes audits, compilations, forecasts, and consulting. He also assists real estate clients with sponsor transition procedures and project management. He's currently the co-chair of New Jersey's CAI's membership committee. Debbie Pasquarello specializes in community association insurance and is currently the insurance professional responsible for approximately 450 communities. She holds the designation of Certified Insurance Counselor and Community Insurance and Risk Management Specialist. Debbie has taught seminars for CAI on both the local and national level. She has had articles published in Community Trends and Common Ground, and was a contributing author for a guide to self-managed communities. She served 6 years on the CAI New Jersey Board of Directors and has also served on the National Insurance Professionals and Risk Management Committee for 20 years and is a past chair of that committee. Mohammed Saliani is a manager at Wilkin & Gutton Plan who joined the firm in 2001. He specializes in providing audit, review, and compilation services to not-for-profit organizations, closely held businesses, and real estate entities such as community associations. For his real estate clients, he also performs consulting services and agreed-upon procedures, including fraud detection, forecasting, and transition reports for sponsors and management companies. In the past, he has served as the chair of New Jersey CAI's Conference Committee and is currently a member of the New Jersey CAI Senior Summit Committee. Last but certainly not least, we'll have Rich Hausler, who's a vice president and senior financial advisor affiliated with UBS Financial Services, one of the largest banks and wealth management firms in the world. With more than 26 years of experience, Rich helps clients achieve their life goals through a holistic approach focusing on accumulating, growing, preserving, and distributing their wealth in the most effective way possible. However, this morning, Rich's goal is to provide us with insight on the most active, personalized, and cost-effective ways for homeowner associations to manage their investment assets. Rich works with over 100 homeowner association clients, and those clients have a minimum of $400,000 of assets under Rich's investment purview. At this time, I'd like to turn the presentation over to Joe, who will start by looking back at 2011.
Thank you, Jules. when we were trying to come up with a topic for this webinar, we were trying to think of some of the common questions that we get from board members. And some of the most common questions that we get are we in a good financial position? How are we doing with respect to reserves? And what are some of the things we should be looking at when we're analyzing our financial results for the year? So what we did was we started with what we think is the foundation of what all board members should be basing all of their decisions on. And it's a simple statement, and it's the board has a fiduciary responsibility to maintain and preserve the common elements of the association. So what does that mean? That's a pretty important statement right there. When you think about it, the board is entrusted in managing most people's largest asset, which is their home. And the board has a responsibility to maintain the value of that asset. And you're going to find that during the course of being a board member, there's going to be situations and opportunities along the way where a board can enhance the value of that asset and improve the value of that asset. So what we're going to talk about today is looking back at 2011, and we're going to assume that everybody here is working off the December year end. So everybody has a calendar year end. So we're talking about the calendar year of 2011. And we're going to look at a few things. We're going to look at what a board member should focus on when we're looking back at the prior year. What can the board learn? And what action steps should the board take going forward? So there's a couple things when you're looking back at 2011. You want to take a look and determine whether or not the year resulted in a deficit. And more importantly, you need to determine the specific cause of that deficit. So we're going to look at comparing budgets versus actual. And there's a few things that we thought that this was a good opportunity because there were a few events during 2011 that were unique to 2011, but they gave us an opportunity to plan for the future. And we're going to talk about what we've learned from those events and how we can use them going forward. And some of those things are the inclement weather from 2011, Hurricane Irene, the October snowstorm, as well as collection issues, bad debt issues, collection issues. We're also going to talk about what the board should focus on when they're talking about the replacement fund. We're going to talk about if there were recommendations from your professionals, specifically your auditor, and what action steps the board can take based on what they've learned from 2011.
So we're going to start with the polling question. And the polling question is as follows. Are you considering the need for a special assessment due to deficits that occurred in 2011? Please select one of the three, yes, no, or not sure. We have a large group listening today, so we're going to give you just about 3 or 4 more seconds to respond. So the responses are approximately 14% of you are saying, yes, we are looking at a special assessment. Wouldn't be surprised if it has to do with snow, and we'll be talking about that in a little while. 71% of you said no. And 14% are really not sure whether you'll be having a special assessment for deficits that occurred in 2011. Joe, back to you.
Well, thank you. So the first thing we're going to look at, and this is in connection with analyzing your data and deciding what to do if you did have a deficit, or even if you don't have a deficit, you should be looking at your budget versus actual each month and at the end of the year to get a better understanding of what happened during 2011, and is there anything that you can improve upon going forward to 2012? So I have a few examples here that I'm going to go through. First is township reimbursement. Now the reason I bring up township reimbursement is we've had a few clients in the past that didn't agree with the amount of money that they were getting from their town. So we took a look at the actual application for the township reimbursement, and then we also went back to the town to get a copy of the ordinance and the formula that goes into calculating how much an association should receive. Many times when you're budgeting for township reimbursement, it's based on prior years. You know approximately a percentage of the expenses that you're going to get back. And then that budget versus actual variance can be explained by the amount of expenses that were actually incurred. Was there more or less snow than expected? Then there's also street lighting and leaf removal and many times trash removal as well. But the only thing I'm suggesting is maybe take a little closer look at your township reimbursement to see if what you're receiving does agree with the actual formula that your township, the way the township actually calculates your reimbursement. The second is water expense. Now, the water expense, I use this as an example because water rates have been increasing dramatically over the last couple of years. And what's happened in certain associations in the past is sometimes you discover other problems that are going on in the association, maybe some irrigation problems, some pipe breaks, and you find that through your water bills. You get a large water bill, you know there's a problem. But now that the water rates have really been increasing dramatically, there have been times where those increases have disguised other problems. So you may look at your budget, your simple budget versus actual, and say, okay, we're in line or we're over budget, and the rates have just been going up, and that'll explain the variance. But that doesn't always tell the whole story. With water, for example, you could take a look at the actual usage and compare that to prior years and use some non-financial variances to get a better understanding of what's going on. You could look at the gallons of water that were used based on your water bills from this year versus last year and see if that makes sense based on the events of the year. The other example I use is bad debt expense. Does the board have a collection policy? Is it communicated to your attorneys? And how aggressive is that policy? I'm not going to go into too much detail because I know Mohammed will be touching on this a little bit later in the program when he's talking about analyzing your monthly reports going forward. And the reason I bring up these is not necessarily to focus on one specific expense. And I'm not suggesting everybody go home and take out all of their water bills and compare it to the last 3 years. The idea was just to get you thinking about other ways of analyzing your financial data from prior years and getting a better understanding through thinking outside the box a little bit and think about some of the things that affect those variances and not necessarily just looking at your budget versus actual. That brings us to the next topic, which is dealing with your inclement weather from the prior year. We had a historic 2011. Hurricane Irene is only the second hurricane ever recorded to hit land in New Jersey, and it's the first in over 100 years. And the last time Newark recorded snow of any kind was over 60 years ago in 1952. So we have a few things that happened during 2011 that we can learn from going forward. Now the insurance side of it, I'm not going to go into detail with the insurance because we have, like Jules said, we have Debbie Pasquarello here. It's going to go into detail on the insurance issues and what can be learned from the events of 2011. But there's some other things that we can learn. Does your association have a form of communication, a way of getting a message out to all of your unit owners in emergency situations? Is there a need for emergency power? Is there a clubhouse that may need a generator or a guardhouse that may need a generator? Is there a way of communicating with your vendors in cases of emergency? Is there a way of communicating the township or the local area emergency response systems? So these are some of the things that need to be considered. And I know that there aren't too many people that are, based on the polling question, that are considering a special assessment, but there may be a need to address some of the added expenses from the October snowstorm and some of the flooding and wind issues that came with Hurricane Irene.
So Joe, you mentioned something. I just want to make sure you clarified that. You said it was the second time that Newark recorded snow, but I think I want to clarify, was that in the month of October?
Yeah, I apologize. That is in the month of October. So
okay.
They haven't had snow in October in over 60 years. So this really was a
A landmark event.
A landmark event. And the damage that came with that snowstorm was extensive, from everything from down trees to power lines to power outages. So there's a lot that can be learned and a lot that you can use from those events going forward.
So let's move on to another polling question. And the question is, how old is your current reserve study? Please select one, 0 to 3 years, 3 to 5 years, 5+ years, or you're not sure. Okay, as someone who attends quite a few board meetings, I have tears of joy flowing from my eyes seeing that we've got 71% of you have really recent reserve studies being 0 to 3 years, 18% of you 3 to 5 years, 8% of you 5+, and a handful really not being sure. So Joe, we're going to talk about reserves for a couple of minutes.
Well, I'm very happy to see the results of the polling question, because one of the most common questions we get has to do with reserves, and board members want to know whether or not they're adequately funded, and it all starts with the reserve study. And understanding whether or not you're adequately funded comes from the study, and you need to have a current reserve study, and 0 to 3 years is perfect. We usually recommend every 3 to 5 years, because you want to be working with the most current information in order to come up with a plan to set aside money in reserves. The second is replacement cash properly segregated. So every year, the board is going to come up with a budget based on the reserve study on how much they should be setting aside so that they have enough money when it comes time to do these large projects. It's key to make sure that you have the proper amount of cash set aside in a separate cash account so that you know that you have the cash available to pay for those projects when they come due. And the other thing to look at is, does your replacement fund balance agree with the engineer's projected balance? Now, there's a few factors that come into play with that. You need to take a look at if there were any large projects that were done recently. Were they done in a similar time frame as was projected by the engineer? And if the answer is no, and your fund balance does vary from what the engineer projected, then you need to dig a little deeper, and it might be time to update your study.
So Joe, we got a question from one of the listeners. What do you mean by properly segregated?
Okay. Well, most associations have at least 2 what we call funds, and they're pools of money that are there for different purposes. You have your operating fund, which is there for your regular operations throughout the year, everything from insurance to management to your audit fee to your landscaping, everything it costs to run the association throughout the year. There's another fund, which is the replacement fund, and that is for everything, all of the common elements. You're setting money aside so that you have enough money in the replacement fund to pay for the replacement of the common elements. And each of those funds will have a cash account assigned to them. And what I mean by having your cash properly segregated is you want to segregate your cash that's for your operating expenses and your cash that's there for your replacement fund expenses.
So, Joe, just to make sure that it's clear, cash doesn't necessarily mean cash like a checking or a savings account. It could be an investment account so that you're earning some interest on those funds. And I guess that's what Rich will be talking about in a couple of minutes.
That's correct. That's correct. When I say cash, it incorporates all of the investments that are in the respective funds, and that could be CDs, money market, and other investment accounts. So the last topic I want to talk about is recommendations from your auditor. So every year during the course of the audit, you should be getting a separate letter, a letter separate from your audit report that has a few things in it. It's going to have standard communication that's required by generally accepted auditing standards, and it's also going to be have information in there on things that came up during the audit that the auditor thought was worthy of communication to the board, and their recommendations of things that they see as areas for improvement. So you want to take a look back at your prior year audit to make sure that all of those recommendations were addressed. And some of the common recommendations are the need for a surplus resolution and dealing with your interfund balances and coming up with a plan to eliminate those interfund balances.
So Mohammed will be talking about the interfund balances in a few minutes when he talks about looking forward to the year 2012. But another listener asked a question in the interim saying, should there also be a segregated deferred maintenance account?
Yes, there should be if that association does have a deferred maintenance fund. Not all associations have a deferred maintenance fund. Most, if not all, should have a operating fund and a replacement fund, and some do have a deferred maintenance fund. And yes, if you do have a deferred maintenance fund, that cash should also be segregated.
Okay, Joe, thank you so much. We're going to move on from looking backwards at some of the financial aspects of 2011 to a hot topic, and that's insurance after those storms and floods and wind. And here's Debbie Pasquarello to speak about insurance.
Hello, everyone. I know that the insurance was a very big topic for both Hurricane Irene and the snowstorm. I'd just like to tell you a little bit about what the couple days before Hurricane Irene was like in our office. We were inundated with phone calls. Everyone wanted to know, do we have flood coverage? Well, the biggest question was, do we have hurricane coverage? And what's our deductible? I think one of the biggest misconceptions was that people assumed that if they have hurricane coverage, which pretty much everyone does, that they would automatically have flood coverage as well. I don't know if any of you watched what happened with Katrina. One of the biggest problems there was trying to determine if the damage was caused by the wind or the flood, the storm surges. So that's a big issue. I don't think a couple days before a disaster is the right time for you to be reaching out to your insurance professional to find out what you have. One of the things that is very important is that you do review annually with your agent what type of coverage you have, what is needed, what are your deductibles, know what you have ahead of time. One of the difficult things is if you just try to do it a few days before, all insurance companies have a moratorium on binding generally a couple days before a major storm hits our area. We start getting the emails from home office, no more binding, no more increasing coverages, no more changes. And if you're talking about federal flood, there's a 30-day waiting period just for that reason. They don't want people to be trying to bind coverage because the storm is on its way. So those are problems that we encountered. Sometimes innocent people get involved in it. I was working on a new account and wasn't able to bind the coverage on their renewal because we had a binding moratorium because of the storm. So it is a difficult situation that everyone needs to be aware of. I don't think a couple days ahead of time is when you should start thinking about it. You should have plans prepared. Joe touched on an emergency plan. We sent out emails to all of our clients talking to them about what you do in advance to protect your community. Make sure your laptops are charged and you have your phone chargers for your cars and things in case there's power failures. Prepare your property. We told people to make sure there's nothing loose on the balconies and decks. If you have pool furniture and you're in a wind area, please make sure you put the pool furniture in the pool. It's not going to go anywhere and damage anything if it's already in there. Protect property that's out in the open. Put it in garages. Put it in storage, anything that you can do. We have clients that have storage sheds on the beach with all their beach chairs and umbrellas and things in it. We told them bring it up to the main building, put it in the parking garage. It won't be covered. Big problem is that things that are out in the open are not covered, so it's going to be an issue. One of the problems we had was with the sub pumps and the power failures. People wound up with their basements flooding and even up into their homes because of the power failure. Sub pump coverage isn't always covered. Generally, it has to be added on. Some companies will add it, some will not. So be careful of that. Make sure if you do have sub pumps in your communities that you do have coverage for them if possible. And the power failures, if you do have a backup generator, it's a really good thing. We don't find that with many communities. More the high-rise buildings will have it more than the townhouse and garden style. So, but that's another excellent thing. When do you need flood insurance? Well, a lot of people I hear say, well, we're not in a flood zone, so we don't need any flood insurance. There's no such thing as you're not in a flood zone. Everyone is in some zone. Flood C is where people tend to say we're not in a flood zone. It's just a low risk. You don't happen to be in a special flood zone, which is your higher risk. But the NFIP folks tell us that about 25% of their floods every year across the country happen in C flood zones, or that I'm not in a flood zone. So we wind up with people that do not have coverage when they really need it. I think you will find that in Hurricane Irene, many of the floods occurred in C flood zones or your low-risk flood zones.
So, Debbie, how would somebody know what flood zone they're in?
Generally, your mortgage company is the watchdog on that. They'll tell you if you're in a flood zone or not, or in a special flood zone or high-risk flood zone. But that is not a trigger as to when or whether you should buy it or not. I think anyone should consider flood insurance, and it's important. And if you're in a low-risk flood zone or a C flood zone, you can sometimes buy it on your regular policy. You don't have to go through federal flood. Once you go into a higher risk flood zone, you can only buy flood insurance through the federal or national flood insurance program, which we'll refer to as NFIP. But generally, a private you can only get if you're in a C or a B flood zone. And it's lower limits. You're not going to get the full, but 1 million or 5 million limits on flood is better than no flood. One of the important things, that just jump ahead a second, is most directors and officers policies, or everyone I've ever seen, has an exclusion for failure to provide flood insurance. So if you don't buy it and you have a flood and your residents sue the board for not purchasing it, there's not going to be any defense coverage for that board, which then becomes a really sticky issue. One of the things on flood insurance is really misunderstood, and I have several accounts that had claims that had flood insurance, and their damage still wasn't covered. And they were quite upset about that. But federal flood is very clear on what they will insure and what they will not insure. So if the community has a seawall or a breakaway wall, and it gets washed away by a big wave that comes and hits them, National Flood isn't going to cover that. They're not going to cover anything out in the open, anything that's part of the landscaping, anything that isn't in a permanent building. So that's why our property in that temporary shed on the beach wasn't covered. But I did have some coastal properties that had damage that was covered and some that wasn't. And they're saying, well, what happens now? How do I replace my seawall? Unfortunately, that's going to come out of association funds because we can't cover it on federal flood. They won't include it. We have another community that actually had such severe erosion on one of their hills that a road collapsed. And it's $500,000 to replace. They didn't have flood insurance because they were sitting on the side of a hill, so they didn't think they needed any. One thing that's important is flood insurance does include mud flow, but mud flow damage to the buildings, not mud flow to your ground. It's not going to cover if your land washes away. We've had several that had landscape damage and driveway damage and things that were washed away. They had flood insurance, but those type of items are not covered on the flood policy. It's more the building damage.
So one of our listeners is asking a question, what's the general coverage of trees on package policies from storm damage?
I'm getting to that. It's actually the next, understanding the limits of outdoor property and trees. There are limits, sublimits on outdoor property and trees which can be increased. One of the important things to know about damage to your trees is the coverage is very limited. I can tell you that they will exclude wind damage, they will exclude weight of ice and snow, and they will exclude things like disease. So you can get very limited coverage for the actual tree itself. Now let's talk about removal of the tree when it comes down. That was a huge question after the October snowstorm because so many of the trees come down. Most insurance policies will cover the cost to remove the tree if it falls on a building or covered property, a fence or sign or something like that. Now let's say the tree falls on one of the residents' cars. The car insurance, believe it or not, under comprehensive is going to be primary in that loss. Your policy, or the association's policy, will cover to remove a tree that falls on someone else's property. Now you're moving under the liability section only if the tree was dead, damaged, or diseased. So if it's a perfectly healthy tree and it was an act of nature that it came down, they don't see that there's any liability on behalf of the association. You know, if you wind up with a papers from an attorney, then it's going to trigger the liability. But automatically, they're not going to trigger the liability if you were prudent in caring for the tree. One of the things I recommend is that you do prune your trees and do have them cared for. They shouldn't just be out there allowed to grow wild and big and knowing that you have huge branches. There's a community that I know of that has so many big trees. If you do a Bing.com on the property, you can't see the buildings. It's all trees. And they've had a lot of damage of roof damage from the tree branches falling off and hitting the roof. So that would be covered. If the tree branches fall and hit your roof, or the whole tree comes down and hits your building, both the coverage to remove the tree and the actual building coverage is going to be taken care of by the insurance policy. I hope that answered your question on that. Was that question? I think I got that one. So basically, that's the tree coverage. Next screen. How much are premiums going up? If I wish I had a crystal ball on this one, but I can tell you that there are cycles of ups and downs with insurance premiums. We've been in a soft market for many, many years. The premiums that we've just experienced over the past few years have been the lowest that I've seen in 20 years. So we knew it was coming. There's been a lot of natural disasters, a lot of increases in cost to reinsure because of these huge losses that are occurring all over. And it's not just in the United States, it's all over the world. But we are seeing increases. We are seeing a hardening in the market. We started to see slight increases last year, but what we're seeing for 2012 is around 3 to 5% increases for most communities. Now, how is that affected if you had losses in 2011? Insurance companies look at your last 5 years of losses versus your last 5 years of premium paid, and that is what we call your loss ratio or loss history. And they will take those losses into consideration when they're calculating your renewal premiums. If you've had multiple losses or you've had large losses, you're going to probably expect a larger increase than 3 to 5%. I think they're going to be looking differently at these acts of nature than they would other types of losses because the boards and management don't really have control over how they have occurred and the severity of them. So they've been quite lenient in those acts of nature claims, but they're still paying money out, so you still may see an increase with it. But it's not going to affect it as much as claims that may arise from multiple water damage losses and things like that that occur. What can you do to mitigate these increases? First of all, you should work with your agent on a risk reduction plan. How can we protect our property? What types of things can we mandate that the residents do? Wash machine hoses, hot water heaters, cleaning dryer vents and chimneys, and checking our property for cracks and different things like that. What can we do to try to protect ourselves from the claims? And then when a storm is approaching, how can you try to protect the property, as we talked about, bringing things inside, securing awnings, protecting things that could be damaged. If you do a little preventative work up front, you might prevent that claim. And work with your agent and your residents on different ways that you can protect it going forward. You might want to check on things like the liability ends and tort immunity and things like that. But there's just different ways that you can work with the agent and your residents to try to protect your community to prevent the claims from building up and from your premiums from increasing.
So Debbie, those are some great insights. We have one more follow-up question before we get to Mohammed. One of the listeners asked, specifically, can coverage for tree damage or down trees from storms be purchased? And do you have a sense as to what the cost of that would be?
I don't see a specific endorsement available to take care of down trees. There is some coverage for tree falling. I just actually was doing a review of, in comparison of a couple of policies, and I did see one that included $15,000 worth of tree removal. But like I said, most insurance companies will do the tree removal if it falls on covered property. If it falls in the woods, you're probably going to wind up with the insurance company saying that they won't pay for that. I don't know of anybody that would specifically take that exclusion away, but it's something that it's worth asking your agent to find out for you. Each insurance company handles it differently. I hope that answers that question.
Terrific. So we've had a flood of questions. We're going to move on to Mohammed, and at the end we'll try and cover a couple more questions. So Mohammed, we're going to start. Thank you again, Debbie. Mohammed, we're going to look forward to 2012.
Thank you, Jules. While looking ahead, we are going to analyze monthly reports and discuss what we should be focusing on. We will also understand the replacement fund better and build on what Joe spoke about. We will also apply what Joe spoke about regarding 2011 into 2012. And lastly, we will talk about potential projects for the board to undertake in 2012. While analyzing the monthly reports, the board should compare the budget versus actual on a monthly basis and investigate significant variances. Obtaining the reason for the variance will help in dealing with the issue. Is it due to items beyond the board's control, or is there any underlying problem? Should the board take action to address the variance during the remainder of the budget year? For items that are over budget, does the board have savings in other areas that will cover the shortfall? If the additional cost cannot be covered, should the board take steps to cover the shortfall right now? For example, snow removal costs. Or should the repayment be spread over time? For example, a drainage project for which the benefits will be seen in the future. The board should also monitor its assessments receivable. Are the assessments receivable decreasing on a monthly basis? The board should discuss the trend with the attorney and review the current steps taken. Are they enough, or does the board need to do more to change the situation? We recommend you visit our website to view and see our previous webinar relating to this at this address.
So Mohammed, we're going to touch base again. We did before with Joe on replacement funding. We're going to do this again looking forward. And we have a polling question for the audience. What kind of funding are you using for your replacement fund? Are you using full funding, threshold funding, baseline funding, or not sure what kind of funding you're using? Okay, if you asked this question a few years ago, you would find the overwhelming majority of associations are using full funding. In this non-statistical poll of those of you listening, we have 18% of you using full funding, 45% using threshold funding, 5% using baseline, which is a little risky. We can talk about that. And a third of you, don't take this the wrong way, should probably find out what you're using so you know what type of risk you're taking in your funding plan. Go ahead, Mohammed.
Definitely, Jules. I think it is very important that the board understands what kind of funding it is using. And you can get that from the report that the engineer gave you, or you can speak to the engineer about what kind of funding plan you're using. As Joe said earlier, it is very important to understand how old your study is. I was pleased to hear that the majority of you had studies that were less than 3 years old. In these current economic times, it is very important to allocate sufficient funds to the replacement fund. In our experience, if the study is over 5 years old, there is a significant doubt that the amount allocated is enough to pay for future projects. As the polling question asks, there are 3 types of funding, mainly baseline, threshold, and full funding, with baseline being the most aggressive, whereby the board estimates that the fund will never go below $0, and full funding is the least aggressive, where you're technically funding for each item separately. The board needs to decide what method to use while funding based on the association's financial position. Not funding in accordance with the study is going to put the association in a position where there will be insufficient funds, and the board may not have enough funds for a project and might need to undertake a special assessment when a project needs to be undertaken. If the association has an upcoming project in 2012 or 2013, does the association have enough funds to pay for the project? In case there are insufficient funds, has the board considered obtaining a loan and paying it back using a special assessment? Or does the board consider postponing the project until enough money is collected in the future?
So Mohammed, if you go to a board meeting and the board tells you, we don't want to update our study because we think that the engineer is going to tell us to put away more money than we can afford to put away, what do you tell the board in those situations?
Jules, if the board does not update the study and continues to fund inadequately, there will be insufficient funds available to undertake projects as needed. Therefore, a special assessment may be needed to be implemented, and the then current unit owners will have to pay for the replacement of an item that was not used by them. We recommend pay as you use rather than pay as you replace. We're now going to move forward into understanding the 2011 audit. During the course of the year, you will be receiving your audit from your auditor. It is extremely important that the board understand the association's financial position. If the association has a deficit, what are the reasons for the deficit? And what options does the board have to eliminate the deficit? Are the audit recommendations the same as the last year? It is important to understand why the auditor is making these recommendations. For example, if the auditor recommends documenting the approval of major projects in the minutes, it is to safeguard the board in case questions arise in the future. The auditor is the best person to provide possible solutions for matters brought to the board's attention. For example, if the association has an interfund balance, the auditor can help in understanding how long the board should take to eliminate the interfund balance.
So Mohammed, we should do a 5-hour webinar on audits, which we clearly won't. But let me ask you just one short question about audits. And that question deals with interfund balances. If a financial statement shows that one fund owes the other fund a significant amount of money, what happens if the board says to you, let's just ignore it? Won't this just go away?
First of all, I'd just like to explain what an interfund balance is. An interfund balance is when basically one fund does not have enough cash that agrees to what the fund or the books say, and therefore one pocket owes the other pocket. Eventually, the association will not have enough cash in the fund, for example, the replacement fund, to pay for replacement projects, and the board may have to resort to passing a special assessment. Secondly, there are tax implications for not segregating funds correctly. I would also like to answer a question that was asked earlier relating to surplus resolutions. When the association has its tax return filed, the fund or the surplus that is reflected in the tax return may be different from the surplus that's in the financial statement. And the association is required to file a surplus or sign a surplus resolution in case for tax purposes it has a surplus to carry it forward to the next year.
Terrific. So let's move forward to what are some of the potential projects that boards might be considering for 2012?
we recommend that some of the projects the association should consider, one of them being a code of ethics for the association. A code of ethics is essential to ensure that the board, as it turns over, matters are dealt with consistently. Here we have on the screen, we have a website, we have CAI's website where you can get a code of ethics. You can tailor this to your requirements. New board members need to understand that they cannot be on the board to fulfill a personal agenda, but that the position comes with a lot of responsibility. It is very important for new board members to understand that their main goal is to preserve the property values of the association. The board should also document the duties of the president, the treasurer, and the secretary to ensure that the board runs coherently and the objectives of the board are met. The board's policy for collection and write-offs should be done with input from the association's attorney to ensure that all avenues have been exhausted before anything is written off. When formulating an investment policy, the board needs to consider what major projects it's going to have in the future and discuss it with their investment broker before making any policy.
So those are some great things to look at for 2012. And before we turn it over to Rich Hauser to talk about investments, one of the listeners was asking a question, talking about financial statements. Don't mortgage companies look at the reserves that an association has or doesn't have when they approve loans, either for a co-op or for an individual buyer of an association? And would the lack of reserves possibly have an impact on being able to get a loan?
Yes, especially now with FHA approvals that are required for a lot of the lenders. It is very important that the association has an updated replacement fund study, and that the cash that is being used, that is set aside per FHA requirement, needs to be at least 10% of the association's full budget for the year.
Terrific. Mohammed, thanks so much. We're going to ask Rich now to talk to us about association investments and investment policies.
Thank you. Welcome to my session, Financial Planning for Homeowner Associations. We often hear the term financial planning as it pertains to an individual's approach to managing their assets, employing various investment strategies with the hope of achieving their lifetime goals. I believe it also important for homeowner associations to take a similar approach with regard to managing their financial assets to ensure that their long-term goals will be met. The main goal of my presentation is to increase your knowledge level and understanding of various investment strategies and the overall importance of long-term planning for the properties that you may live in or service. This in turn will raise your level of professionalism and strengthen your relationships within the homeowner industry. Joe mentioned fiduciary responsibility earlier in the webinar, and I'm going to stick with that theme as well. Fiduciary responsibility should empower the board regarding the financial management of their association assets. The financial responsibilities of the board may be their single most important area of concentration. This will invariably result in difficult financial decisions and periodic increases in homeowner association fees over time. While these may not be the most popular choices, it is critical to keeping up with inflation and related increases that are sure to exist over the life of a property. These are quite often some of the tough decisions that board members face and have a responsibility to address head-on. I would suggest that the board make the financial matters of the association a primary concern and stress the importance of keeping this topic front and center on its regular agenda. I suggest each association adopt a mission statement to provide a simple and clear directive regarding the board's financial responsibilities. For example, the board of directors is charged with the fiduciary responsibility of managing the financial assets of the association. The primary objective should be the preservation of capital while maximizing the earning potential of all association-related funds. A secondary objective should be advanced planning to ensure that periodic reserve studies are performed and appropriate funding levels maintained to ensure that the long-term expenses are met while minimizing costly assessments or loans. I also suggest each association adopt an investment policy to provide overall guidance regarding the financial management of their property. An investment policy is a document that spells out the fiduciary responsibilities of the board along with investment guidelines governing their actions. The policy should address the following 4 key issues. Establish the fiduciary responsibility of the board. Establish procedural and control guidelines for maintaining investment accounts. Specifically address investment risk limitations, and set specific criteria for security selection. The investment policy empowers the board to perform their duties within the acceptable parameters of fiduciary responsibility. It is also a mandate for future boards to ensure smooth transition as the property ages and board members change. The importance of being diligent. One of the critical elements of a successful investment strategy is diligence. It is important to ensure that investment return is maximized by following established investment strategies and minimizing money market balances versus longer-term securities. Investments need to be closely monitored so that maturing securities are quickly reinvested. There should also be special attention paid to rising money market balances due to monthly contributions and earned income throughout the year, which offer additional opportunities for investment. This leads to some forward thinking about investing and employing various strategies to help maximize the return on assets. I would now like to discuss investment strategies in greater detail. The 2 most popular long-term fixed income investment strategies are laddering and the barbell approach. Both strategies are best suited for properties that have adequate assets and can diversify its holdings. Both strategies may offer the following benefits: greater overall earned income versus standard short-term investments, increased cash flow to keep pace with inflation or help meet ongoing expenses, limiting reinvestment risk in downward interest rate cycles, since only a portion of the portfolio matures in various intervals, increased earned income in rising interest rate cycles, since a portion of the portfolio is always scheduled to mature in various intervals. The laddered portfolio. Laddering involves building a portfolio of fixed income securities with staggered maturities so that a portion of the portfolio matures every 6 to 12 months. To maintain the ladder, maturing securities are reinvested into longer maturity securities on the outer range of the ladder. Laddering tends to perform very well against other strategies over time because it simultaneously accomplishes 2 main goals. Insulates a large portion of portfolio from maturing during a low interest rate cycle, similar to what we've been experiencing over the last year to 2 years, and reinvest principal from maturing securities into new longer-term securities, which are typically higher yielding. The primary goal of a laddered portfolio is to achieve a total return over many interest rate cycles that compares favorably to the total return of a long-term portfolio with much less reinvestment risk. The barbell portfolio. A barbell approach splits the assets between short-term and intermediate to longer-term maturities. This strategy provides the ability to maintain a portion of the portfolio in short-term securities which offer earlier reinvestment at possibly higher yields while also securing a greater return on the overall portfolio through the longer-term securities, which typically provide a greater yield. It is a common strategy used when investing in a flattened yield curve, such as the current environment. Barbell tends to perform very well against other strategies during flattened interest rate cycles since it accomplishes 2 main goals. It offers short-term reinvestment on a portion of the portfolio at possibly greater yields, and it provides greater overall yield on the portfolio due to the longer-term securities. The primary goal of a barbell portfolio is to achieve a greater return over a specific time period than a laddered or short-term portfolio would provide. Two additional fixed income opportunities are step-up and market-linked CDs. Step-up CDs are FDI-insured CDs which typically offer an attractive initial interest rate along with a graduated or step-up rate schedule over the life of the CD. Step-up CDs are designed as a hedge within a fixed income portfolio since there is a guaranteed rise in the earning power of the funds invested regardless of whether stated interest rates rise or fall. Step-up CDs are typically callable by the issuer after a predetermined time period, usually 6 to 12 months from inception. Market-linked CDs are FDIC-insured CDs which are linked to a security index, such as equities, currencies, or commodities, and offer the opportunity for growth without the risk of principal, and quite often with a guaranteed minimum return if held till maturity. The three most attractive features of market-linked CDs are the relatively short time horizon of 5 to 7 years for a growth type of investment, exposure to potentially high-growth investment themes, and the possibility of a guaranteed minimum return in some cases. With interest rates at historic lows, it may be a good time to consider alternative investments such as these as a hedge versus a 100% fixed income portfolio. Current action steps I would take now. Short-term assets. I would recommend limiting low-paying money market balances by investing in short-term securities such as CDs. Laddering within a 1-year time frame may provide a periodic cash flow to cover anticipated expenses. In this case, short-term securities can be used as a cash management strategy. Intermediate to long-term assets. I would recommend maintaining a short-term laddered portfolio not to exceed beyond 2 to 5 years in maturity. This would be considered the laddered portfolio approach. This investment strategy will allow for participation in the spread of short to intermediate term rates versus low-paying money market funds, while avoiding the risk of committing funds long-term at historically low interest rates. Longer-term assets. Add a longer-term component, possibly 5 to 10 years, as an interest rate hedge. This would be considered the barbell approach. This investment strategy will provide reinvestment opportunity for a significant portion of the assets while ensuring a greater overall return by locking in higher rates with the remaining funds. This is appropriate for those properties that have adequate assets to diversify their portfolio and satisfactory short-term funding to afford them the ability to invest a portion of their monies longer term. Step-up, market-linked, or long-term securities can be considered for the long end of the barbell. In conclusion, I would say that financial planning is an ongoing process. It involves constant attention, including carefully monitoring disbursements, investments, and expense forecasting to ensure the security of association assets and the best hope for achieving long-term goals. An active board, a dedicated treasurer, and well-informed and knowledgeable industry professionals are the most important components and should help your properties reach their financial goals with the greatest success rate possible. Thank you for participating in today's webinar. Please let us know if we can answer any questions that you might have at this time.
Rich, thank you so much. We have many questions that we just physically do not have the time to answer. It's just about 1 o'clock. We'd like to thank Joe, Debbie, Rich, and Mohammed for their wisdom and for making this an interesting and informative webinar. We want to thank all of you for listening. If you have feedback, please write to us. You see the emails on the screen right now. We hope that you'll join us for future webinars, and it's not too late in the year to wish all of you a happy, healthy, and prosperous new year. Thanks, and have a terrific day.